G'day there. Welcome to the closing bell on the 9th of Feb for me. And I thought today just kick off looking at 2-year bond yields in the US and have a think about where things are at. Because, everyone's talking about rates are about to come down. Pretty much the market is on that bandwagon. And the assumption being, after we've had a tough few years, that rates coming down and everything will rally. And, is that the case when you look back at history? So let's just have a quick look at what's happened in the past and get a sense of where we're at. I don't think you'll end up knowing what's coming next, but it'll help you to navigate things as news comes out, in future, about what can happen in these situations. So just starting off by pointing out, we've got the S&P 500 in this upper chart with a log scale. So it's looking at percentage moves. That's so you can look back in time, and it's all relevant. You should know what a log scale is if you've been looking at the markets. And looking down here at the 2-year bond yield over that time period. And I'm looking at a monthly chart. I've got my, sense of trends being that 10-period exponential versus the 20-period simple. So we're just getting a sense over time of the shift in these 2-year bond yields from trending up to trending down. It's never perfect. You can see right now, very close, but not quite there yet. So that's the first thing to think about is, yes, we are getting close to a long-term trend shift. So possibly, if we're looking back, it's been pretty amazing, hasn't it? At giving you the sense that once those 2-year bond yields reach a peak and then start trending down, it can be pretty rapid, the change, can't it? Because you have that cyclical peak in rates. So noticing, going back all this time, 95, 2000, 2007, 8, 2020, you can see that those peaks falling, going lower and lower. The peak in rates that were reached before rates then went back down again. So, interesting to note that whatever this peak will be, we don't know yet whether that is the peak, but we're sensing that it might be, that it is actually a lot higher than the previous cycle peak, and is actually closer to the one in 2007 to 2009. That's the first thing to note. It's the first time in decades that we've actually seen, a higher peak in rates, and that's because we have to chase down inflation. But the other thing I wanted to point out was, everyone going on about, well, if rates turn down, then it's bullish for stocks. So let's just have a look at a few cycles here back in, 2000 and or 2000 to kick off, and looking at 2007, 2008, and I think we all know that if the Fed raises rates rapidly to maybe end speculative frenzies or whatever it happens to be, and look, they're not very vertical, are they? But you get the sense of what I'm talking about, that things can break. And when things break, the Fed is then lowering rates into the crisis. And same here, lowering rates following the stock market down. So as stocks crash, the Fed is then changing course and lowering rates rapidly. So rates can drop and stocks can drop rapidly. So that's the first thing to accept. And it's usually when something breaks. Second thing is that as long as rates are kept high, it can be tough for the market. So at the moment, we're at this period where the Fed's saying, look, we're going to keep rates at this level for a while. And it is actually keeping rates at that high level that can lead to problems as businesses roll over loans, as they, as time passes. There's more and more loans need to be ratcheted and done again at a much higher rate than what they were previously. So things have a higher probability that you are going to see something break. If we look back in that 2005 to 2007 period, rates were kept high for quite a while, and stocks kept rallying during that period. And then we got the Bear Stearns, property funds and mortgage securities and that sort of thing. We got that news come out, and we had the hint that there was problems, and stocks kept rallying. And then things really started to go wrong, and we went into that 07 to 09 crash, and rates dropping as stocks crash. So keeping rates high for a long period can actually be problematic until something breaks, and then down it goes. So we're sort of in that phase right now of rates staying high. And because we've had rates dropping, financial conditions are actually easing up, which means growth is actually picking up. So we're going to see growth worldwide starting to ratchet higher. We're seeing stocks take off. So does inflation actually hold steady or pick up from here, which means rates are going to have to stay higher, especially in those 10 years and that sort of thing. So it is on tenterhooks right now. It's not a done deal yet that the trend is down in rates, is it? It's not actually confirmed. We're not in this phase yet, are we? So you have to allow stocks to trend. We know that they're broken out to new highs in the S&P. There's nothing stopping the market from rallying from a technical perspective, apart from some resistance levels I'll show you in a minute. So you are bullish, but just being aware that with financial conditions easing, rates holding steady at a high level, and possibly, if things really do ratchet up with growth, maybe inflation comes back. That's the spanner in the works that could come down the track. So we do need to be aware of that. But also looking back and saying, well, it's not always the case that something breaks and then rates fall and stocks fall, because some people end up thinking that because of what's happened over the last few decades, people sort of get caught up in that view. But, looking back, we had the recession period, rates coming off there, stocks went sideways, weren't really rallying in that period, but then started sort of grinding higher, not at a rapid pace, because this is post 87. And we had this period in 94. I remember it. I was on the futures floor at the time, and bonds got absolutely creamed because the Fed surprised the market with rate increases, and rates went higher at a rapid pace. Stocks, struggled during that period. But then when rates turned back down and really took the pressure off, look what happened. We went into the 5-year very strong bull market, and with rates basically sort of holding steady and not really rising rapidly during this period. And so that really did take the pressure off the market going sideways while rates were rising. Rates fell, and then all of a sudden the starting gun went off, and it was a really strong bull market that ensued. And you can see that in the end, it only finished when from 98 to 2000, rates again started ratcheting higher until something broke. And then we had the tech crash, and obviously stocks and rates ended up falling. So, the question is, are we sort of in a period that's similar to, 1990 or 95, 96, where rates are going to come off and really let the market loose. It's broken out and, off to the races. If this AI really takes off and, companies across the board are increasing margins, probably sacking people, quite frankly. And, that could be the case. And this is where I said, this is a history lesson rather than this is what's going to happen next. But just being aware that all those articles you read saying that stocks will definitely rally if these rates start to fall, it isn't necessarily the case. You've got to be aware of that, especially if something breaks. Commercial property problems really rear their head. China, there's problems there. Evergrande has been liquidated. Is there flow-on effects, systemic issues that are still underlying? Their deflation is actually a problem there. And that may then spread out, I guess. I guess fears on inflation for myself, I'm thinking it may have been licked. But we've got to see how growth goes in the US going forward. I think we are going to see a pickup in growth. And for the moment, you're allowing this trend to take shape. And, pretty much tentatively bullish. We want Aussie stocks to actually break out. So let's switch to the S&P to just have a quick look. I mean, looking at US stocks, it's entering a different phase, isn't it? It's really taking off like a rocket through that all-time high. So we're allowing this trend to take shape. And when you look at the big picture, if I'm looking down here at my little indicator, all that's showing is on that blue line, the slope of the 20-month moving average. So really big picture trends. So it just gives me a quick sense of what's going on. And the red one, the slope of the 10-month exponential moving average. And, really big picture, looking at that slope of the 20-month over time, it's been really strong at giving a sense of the trends that are going on. Trends down, and that actually turned up in about 2010 when that slope turned up and never went negative again, even though we've seen all those volatile periods over that time. The only time it turned down was actually in 2022. Here was where that slope turned down. We saw weakness, but now it's actually turned up again. So big picture, really big picture on those trends. I mean, you're just allowing that to play out. And, it could go on for a long time, all this year. Who knows? But what I set up when I look at things like this is, where is the resistance levels outside the range that we've been in the last few years? And there's two little areas. I'm very quick with this. 25%. So here's that range that we've seen over the last year or two in the S&P 500. It's broken out, but there is levels around 25% outside, and the 618 above, that's a long way above. That's around 5,600. So it'd be a nice big rally if it could get up there. But they are just areas where in the past I've seen high probability of reversals and moves back towards the midpoint, that point of control. So if you need proof on that, I can show you plenty of proof on that occurring in the past. I mean, let's just look here. If I'm just looking at that period in 2018 to 2019, we had the correction here, and then I'm looking at that area, 25% above and 25% below as areas where reversals often happen, and also 618 the 0.618 below as an important area. So you can see when this rally happened, you get the rally, everyone gets bullish, selling pressure comes in, down it goes again, back to the midpoint, and then on the bottom side, lots of stop losses going off below the range. There's that level 618 below, and that was actually the beginning of the next rally to the upside. And look, I could show you a million examples, and I don't want to take up too much of your time. But basically, that's the only resistance levels that I can point out, because we're at new all-time highs, aren't we? And the thing is trending strongly. So you're just allowing it to play out. You're more on the front foot, especially if, God, the small caps can pick up. Not many of them are. Still that massive divergence going on. I think it's getting a bit overblown and overheated. I think around this zone is the danger spot this year that may cap it out, and we'll end up having a bit of weakness. So that's sort of how I'm looking at things, just allowing the trend to play out, keeping an eye on those 2 years and the 10 years, watching out for if rates really do start heading up again, because growth starts really picking up. That could be the spanner in the works for us. But for the moment, you're, got to be bullish. You've got to be allowing this rally to play out, because what if we're here and we're about to see a really nice run? And, certainly we've got all of the conditions in place. Long-term uptrend. We've got the buy pivot there when I turned from bearish to bullish, and off she goes. So just allowing it to play out, but knowing that there is resistance overhead. All right, I'll come back with more next week.